Well, the interest rate and currency markets are waiting with bated breath for a couple of very important events later this week. We've seen the euro currency, for example, decline in value against the U.S. dollar because European Central Bank President Mario Draghi has been consciously trying to talk down the value of the euro in an effort to spur inflation and economic growth in the eurozone vis-a-vis the U.S. Meanwhile, in the interest rate arena, after kind of seeing a capitulation among traders who were short the bond market, we've seen prices of bonds fall for the past few days and interest rates rise as economists, investors, and analysts reassess the strength of the U.S. economy. We've gotten some better economic data that may suggest the 1% decline in the first quarter for U.S. GDP was more weather-related and that we're seeing a bounce back in the second quarter. So as a result, you're seeing interest rates tend to come back. We've risen from about 2.4% on a 10-year Treasury yield, for example, to around 2.57% in just a few days. Well, again, Mario Draghi in the Eurozone was facing a situation where the euro was basically rallying on good news for the European economy, bad news for the European economy, pretty much any news, as investors were flocking into peripheral European bonds. That would be bonds issued by countries like Portugal and Spain and Italy. They had very high yields, but after Draghi basically said, we'll do whatever it takes to stand behind those government bonds, investors had been dogpiling into them, driving prices higher and yields lower. And in order to execute those trades, they had to buy the euro currency because that's the currency that you're transacting in. Unfortunately, that has driven down inflationary pressures in the Eurozone such that the ECB is very worried about a deflationary environment emerging and actually deflationary spiral at some point. We've seen some very light news on the inflation front over there. So the European Central Bank is going to look to combat that by driving its currency down, by taking other steps such as Euro QE or actual negative interest rates on deposits that banks hold with the central bank. The government or the ECB really wants the banks to go out there and lend with that money instead of just park it at the ECB. So all of those factors will come up, and depending on what the ECB does on Thursday, it could significantly affect currency values as well as stock values and interest rates. Well, the May jobs report is important because it will tell us whether or not, it will be a key factor in understanding whether or not the first quarter slowdown in U.S. GDP is continuing into the second quarter with all the impact you would expect to see on hiring, retail sales, and consumer confidence, or if it was truly related to weather, to some inventory drawdowns in corporate America, and if the economy is really bouncing back. I think the bulls on the economy would want to see a number in terms of jobs creation of at least 200,000 and preferably more than 250,000 on the month. Whereas if we get a number that's 150,000 or below, it's going to confirm that maybe something deeper than just weather is going on here in the U.S. economy, and that we face some longer-term structural problems when it comes to unemployment. So that'll be a real issue for the market, especially as we get into it later in the week and see what these numbers are. This is Mike Larson with Money and Markets. Thanks for listening.